Ira, I'm going to start with you because I think you're at the center of the action here. We're trying to figure out how to hedge the Fed. What is going on this morning with the bond market?
Yeah, so we're seeing more flattening in the yield curve. I think that's not a big surprise, given that the risk is for the Federal Reserve to hint that they're going to go even higher than what the market's pricing in terms of the dot plot, for example. So remember, with this meeting, not only do we get the post-meeting press conference, but we'll also get the summary of economic projections. So we'll see what do the members of the Fed think for both the economy, inflation, real growth, and importantly, that dot plot. I think the single biggest thing that I think the front end of the curve is starting to price for, and why you see two-year notes up almost over 8 basis points at the moment, is that if the Federal Reserve, even if they hike to 4.5% or 5%, like Bloomberg Economics and Bloomberg Intelligence think, if they keep the rates there for say 18 months, then it makes perfect sense for the market to be pricing for what it is. If we had been pricing for pretty early cuts, and if those cuts don't materialize, or the market doesn't think that they'll materialize, then two-year yields can go even higher.
I mean, we're like a stone's throw away right now from 4% on the two-year. That's going to be pretty impressive. Kriti, I'm wondering why the equity market isn't down more.
Well, it was down more. It was down almost 1% in the pre-market, and I think this is crucial here because I think the question of the day is, how do you hedge the Fed, right? Well, you're doing it right now. You're having this kind of turnaround story when it comes to the stock market. I'm going to throw out a stat here from our very own macro man, Cameron Kreis, because I think he phrased it perfectly. A lot of the kind of down note that you're seeing this morning is really a hangover from options expiry that you saw on Friday. The heavy volume, a lot of people getting out of their positions ahead of the weekend. That being said, you do tend to see a little bit of a down note before the FOMC meeting. That's been a trend definitely throughout 2022, and I'd argue throughout 2021 as well. But the stat that came from Cameron Kreis here was that Friday was the 9th monthly expiration of the year, the 8th time that the stock market has fallen during the expiry week, and 6 out of those 8 times the following week, you see a rally of about 1.3%, or actually, excuse me, 1.5% on the week. So potentially that's what's starting to happen right now. The idea here that you're kind of selling the rumor, potentially buying the news on Wednesday.
Kriti, one of the other questions that Cam asks is, where do you put your stops? And this is, I think, what a lot of people are trying to figure out right now. The extent of the moves that we could see this week. How much volatility are we expecting? And how do you think people are positioning around that volatility? To come back to the question of volatility, to come back to the question of the day, how do you hedge what is going to be a really bumpy week potentially?
Well, you asked Ira that question, right? What the heck is going on with the bond market? Well, the expectation in the equity market here is that as we go throughout the week, the rates volatility will actually decline. And if that is your base case, that going into Wednesday, you'll actually see a lot of what you're going to hear on Wednesday priced into the market already, the 2-year, the 10-year, flattening of the curve, you name it, then the equity market, the best way to play it is to start having those call options baked into the market. I've spoken to several traders this morning, and all of them are saying that all the action in the equity market is really going to be a function of the derivatives market. So I think that's where you want to keep your eye here, that especially on those call options, that's where you're going to see heavy volume.
Hey, Ira, if we hit 4% on the 2-year, what happens?
Yeah, I think we probably keep going, and that'll be a signal. I think that the market is really thinking that we are going to have that higher terminal rate, and the rates will stay there for a long time. I think there is a little risk here, and we talk about hedging the Fed. I think with how much flattening we've seen over the last couple of trading sessions, the risk really might be that the Fed goes 75 basis points, and even though they might hint that they could do 75 basis points again in November, that might be a little bit of a relief for the market, and you might actually see a little bit of an unwind of the flattening that we've seen in the last couple of days.
Okay, let's just think, if that is the psychology and the Fed is aware of that, Ira, is 100 a possibility?
So first, I'm not 100% sure that a lot of members of the FOMC are aware that that's a psychology, but 100 basis points is possible. I'm not going to say it's a 0% chance, but I think that from the Fed's point of view, they'll bring up long and variable lags, the fact that they don't want to seem like they're panicking because of the CPI number, and we did get a reasonably weak retail sales report, right? So the data has been much more mixed. If it was all one way, then I'd say that maybe there's a higher chance of 100 basis points, but it hasn't been. And you look at a lot of the survey measures of the economy, and they continue to trend lower. So I think from the Fed's perspective, it's go 75, reevaluate, and then go 50 or 75 in November, depending on what the intermeeting date is.
Kriti, when you talk to investors and traders, what asset is the most vulnerable right now into the Fed?
Oh, geez, that's a tough one because arguably it's all of them, right? I mean, I would actually say maybe keep an eye on the dollar here because it's such a crowded trade at the moment. It kind of seems like a no-brainer here that if you have higher interest rates, if you're pricing in any potential for 100 basis points, even if it is a small chance, then that should create an even higher dollar. But just given how crowded of a trade it is, I think that's the reversal that a lot of people have to watch for.